Before we begin, it is essential that you understand the nature of this content. We are deliberately moving away from the fast-paced, bite-sized information that dominates our digital lives. This long-form format is a conscious choice, designed to mirror the very principles we will be discussing. The value is not in a simple conclusion, but in the journey of understanding. Each section builds upon the last, so to skip ahead is to build a house on an incomplete foundation. Resist the urge to find a simple takeaway. The nuance is the lesson. The language used is precise and intentional. Every word has been chosen to convey a specific meaning, free from hype and sensationalism. We are committing to providing a thorough, uncompromised education. Your role is to engage with it as presented, giving the concepts the time and attention they deserve. The cadence of this video is also intentional, calm, deliberate, and clear. This pacing encourages thoughtful consideration rather than reactive judgment. It forces you to slow down your own thinking and truly listen. We are not here to create excitement or fear. We are here to build confidence through competence. The market is chaotic. Our approach must be the opposite. Intro. Setting the tone. Most people come into crypto with the wrong expectations. They are drawn in by headlines of overnight millionaires and social media posts promising 100x returns. Their entry point is not one of curiosity, but of financial desperation or simple greed. They expect fast money and instant results. They buy a coin and begin checking the price obsessively. Every small dip feels like a catastrophe. Every minor pump feels like the beginning of their imagined moonshot. There is no patience, only a desperate need for immediate validation. They expect every investment to go up immediately, unprepared for the reality of market dynamics where corrections and downturns are a necessary part of any cycle. And when reality fails to meet their fantasy, they get emotional and exit, usually at the worst possible time. They buy the hype at the peak, panic sell at the bottom, and then blame the market for their own lack of discipline. What they don't realize is that crypto is not a lottery. A lottery is a game of pure chance, a tax on statistical ignorance. There is no skill, no strategy, no edge to be gained. It's a market driven by liquidity, psychology, and long-term adoption. Liquidity is the flow of capital. Psychology is the collective fear and greed of millions of participants. And long-term adoption is the foundation. The slow, steady process of real people and institutions finding real utility in this technology. This is what creates fundamental value over time. In this video, we are slowing everything down. We are stepping off the emotional roller coaster and muting the noise. We will approach this topic not as gamblers, but as students, not as speculators, but as strategists. We are going to talk about crypto the way professional investors think about it. People who understand cycles, risk, and patience. Their success is not measured by one lucky trade, but by consistent performance over many years. Their mindset is one of risk management, thesis building, and disciplined execution. That is the mindset we seek to cultivate. This video is designed to be watched slowly. Find a quiet space. Treat this as you would a university lecture or a deep conversation with a mentor. The goal is not passive entertainment, it is active learning. You don't need to rush. The opportunities you are seeking do not have an expiration date. The only scarcity is that of a clear, unpanicked mind. Your first action after watching this should be inaction. It should be to think, to process, to let this new framework challenge your old assumptions. The people who win long-term are the ones who understand first, then act. They build their knowledge, formulate a clear thesis, and only then do they execute with confidence. This is our goal, to move from being a leaf in the wind to being the captain of our own ship. Why most people lose money in crypto? Let's talk about the uncomfortable truth. It's a reality that many in the crypto space prefer to ignore, often hidden behind stories of overnight millionaires and revolutionary technology. The simple fact is, the vast majority of people who enter the crypto market end up losing money. Now, it's easy to blame external forces. You'll hear endless talk about market manipulation, shadowy whales controlling prices, or unfair systems rigged against the little guy. And while those elements can and do exist, they are not the primary reason for the average person's losses. The real reason is far more personal and much harder to confront. Most people lose money in crypto not because the market is manipulated, but because they are emotional. They treat the market like a casino, driven by gut feelings and impulses rather than a coherent strategy. This emotional decision-making process creates a predictable and often disastrous cycle. It starts with the decision to buy. The emotional investor doesn't buy based on deep research or fundamental value. They buy because a coin is trending. They see it on the top gainers list, a sea of green and a market of red, and an instinctual part of their brain lights up. They buy because everyone on social media is talking about it. Their feed is flooded with rocket emojis, predictions of 100x gains, and influencers confidently declaring it's the next big thing. This creates a powerful social pressure, an echo chamber where the only narrative is up. And most powerfully, they buy because they're afraid of missing out. They see screenshots of others' profits, they hear stories of friends getting rich, and a primal fear kicks in. It's the fear of being left behind while everyone else succeeds. This is called FOMO, or fear of missing out, and it's one of the most expensive emotions in investing. It compels you to buy at the worst possible time, when an asset is already overextended and the price is at a local or even all-time high. You're not an early adopter, you are the exit liquidity for those who were. Then, inevitably, the market turns. The parabolic rise stalls and prices drop. This is where the other side of the emotional coin appears. Fear takes over. The same person who bought with euphoric confidence now feels a pit in their stomach. And so, they sell. Why? They sell simply because the price is going down. Their only thesis for buying was, price go up. When that thesis is invalidated, their only logical action is to sell, often locking in a significant loss. They sell because the news sounds scary. The headlines shift from optimistic to dire. Words like crash, bubble, and scam dominate the media landscape. The same social media influencers who were shilling the coin are now silent or have moved on to the next trend. And fundamentally, they sell because they don't have a plan. They never define their reasons for entering the position, their target price for taking profits, or the point at which their thesis would be invalidated. Without a plan, the only guide they have is the raw, unfiltered emotion of fear. This is the cycle of buying high and selling low. It's the retail investor's lament. Now, let's contrast this with how smart money behaves. We're talking about institutional investors, venture capitalists, and disciplined, experienced individuals. Their approach is the polar opposite. It is methodical, patient, and unemotional. Instead of reacting to the noise of the market, they operate from a framework of deep inquiry. They don't start by asking, how fast can this go up? Or, how much can I make by next week? These are the questions of a gambler. Instead, they ask a different set of questions rooted in value and long-term potential. First, what problem does this asset solve? Is it creating a more efficient payment system, enabling decentralized applications, providing a secure store of value? A real-world problem is the bedrock of long-term value. Without it, an asset is just a fleeting speculation. Second, who is using it? Is there a growing community of developers building on the platform? Are businesses integrating its technology? Are daily active users increasing? Usage and adoption are tangible metrics that prove a project has traction beyond just speculative interest. Third, who is accumulating it? They look at on-chain data. Are large wallets, the so-called whales, consistently adding to their positions, especially during price dips? This indicates that the most informed players have strong conviction and are using market fear as an opportunity to buy. And finally, and most importantly, how does this asset fit into a long-term thesis? Smart money doesn't make isolated bets. Each investment is part of a broader portfolio strategy, aligned with a multi-year view on how technology and markets will evolve. They have a plan. This disciplined approach is built on a core understanding. Markets move in cycles. The euphoria that drives retail to buy at the top and the panic that forces them to sell at the bottom are not random events. They are predictable phases of a larger pattern. Fear and greed repeat, over and over again. The names of the coins change. The narratives evolve. But the underlying human emotions that drive these cycles remain constant. The disciplined investor understands this. They see widespread fear not as a reason to panic, but as a potential indicator that the market is undervalued. They see rampant greed and FOMO not as a signal to jump in, but as a warning that the market is overheated and it might be time to take profits. They use emotion as data, not as a signal to act. This single shift in perspective, from being a slave to your emotions to being an observer of the market's emotions, is what separates the consistent winners from the people who perpetually lose. It is the foundation of sustainable success in this volatile and exciting asset class. For a breath pause. Bitcoin. Why it's still the foundation. In the vast and often confusing world of cryptocurrency, one name stands as the genesis of it all: Bitcoin. Yet, despite its decade-plus history and its status as the original digital asset, Bitcoin is often profoundly misunderstood. It's a technology, a currency, and an investment all at once. And this complexity means it rarely fits into the neat boxes we use to understand traditional finance. This leads to simplified narratives, many of which miss the core of what makes Bitcoin so revolutionary. Some people think Bitcoin is outdated. They look at the thousands of newer cryptocurrencies, many boasting faster transaction speeds or more complex features, and they dismiss Bitcoin as first-generation tech, a relic of a bygone era. They see its deliberate, methodical pace as a weakness, a sign that it has been surpassed by more agile competitors. Others think it's just digital gold. This is a popular and useful analogy, but it's an incomplete one. They see its scarcity and its role as a potential hedge against inflation, and they stop there, viewing it as a simple, digital alternative to a precious metal. While the comparison has merit, it fails to capture the full scope of Bitcoin's utility and its potential as a programmable, borderless financial network. And of course, some think it's only for speculation. They see the dramatic price swings, the headlines of overnight millionaires and devastating crashes, and conclude that Bitcoin has no fundamental value. To them, it's nothing more than a digital casino, a playground for traders gambling on volatility rather than a serious long-term asset. But these views, while common, overlook the single most important attribute of the network. Bitcoin's real power is monetary certainty. In a world where economic rules can be rewritten overnight, Bitcoin represents a fixed, predictable, and transparent financial system. This isn't a bug or a limitation. It is its most profound feature. This certainty begins with its absolute scarcity. There will only ever be 21 million Bitcoin. Not a single one more can ever be created. This number is not a guideline. It is encoded into the heart of the protocol, visible for anyone in the world to verify. And that rule cannot be changed easily. To alter Bitcoin's core principles, like its supply cap, would require overwhelming consensus from a global, decentralized network of participants. This design makes the system incredibly resilient to change, ensuring that the promises made on day one remain true decades later. This resistance to modification is what gives Bitcoin its foundational stability. Because of this decentralized structure, no government controls it. Its operations are not confined within any single jurisdiction, and no single political entity can dictate its future or seize its assets without the owner's private keys. It exists outside the traditional levers of state power. Consequently, no central bank can print more. Unlike fiat currencies, which can be devalued through inflation to finance government spending or manage economic cycles, Bitcoin's supply schedule is fixed and unalterable. This protects every owner of Bitcoin from the risk of monetary debasement. This unique combination of properties makes Bitcoin fundamentally different from fiat currencies, which have an infinite supply and are controlled by central authorities. Stocks, which represent a claim on a company's future earnings and can be diluted through the issuance of new shares. Bonds, which are debt instruments whose value is tied to the creditworthiness of the issuer and prevailing interest rates. And even most crypto projects, many of which are run by centralized foundations, have alterable supply policies or prioritize features that compromise the core security and decentralization that make Bitcoin unique. This monetary policy isn't just a static rule, it's a dynamic process. Bitcoin operates on a 4-year cycle driven by an event known as the halving. This is a pre-programmed adjustment to the network that is central to its economic model. Approximately every 4 years, each halving reduces the number of new coins entering the market by 50%. This reward, given to miners for securing the network, is the only source of new Bitcoin. By systematically cutting this issuance rate, the halving ensures that Bitcoin becomes progressively harder to acquire over time. This creates a powerful economic dynamic. Less supply plus consistent or rising demand notch pressure over time. As the flow of new Bitcoin shrinks, even if demand just stays the same, the existing supply becomes more valuable. If demand increases as more people adopt Bitcoin, this effect is amplified, creating a powerful tailwind for its price. This predictable, clockwork-like mechanism is why smart money doesn't buy Bitcoin because it's exciting. They aren't chasing short-term hype. They are investing based on a clear, mathematical, and transparent thesis. They buy it because it's scarce. In a world of abundance, true, verifiable digital scarcity is a profound innovation. It's liquid. With a market capitalization in the hundreds of billions or even trillions, and exchanges operating 24/7 worldwide, large positions can be entered and exited with relative ease, a crucial feature for institutional investors. It's globally recognized. Bitcoin is the most well-known and trusted brand in cryptocurrency, with the largest network of users, developers, and security infrastructure. And perhaps most importantly, it has survived every crash so far. For over a decade, Bitcoin has been declared dead hundreds of times, yet it has weathered every bear market, every regulatory challenge, and every technical threat, emerging stronger and more resilient each time. This history of anti-fragility provides a track record that newer projects simply cannot match. For these reasons, it's crucial to understand that Bitcoin is not meant to make you rich overnight. Its purpose is not to provide a 100x return in a month. The era of its most explosive, life-changing gains may be in the past. Instead, it's meant to preserve and compound value over time. It is a savings technology, designed to protect wealth from debasement and grow it steadily across economic cycles. It's a long-term allocation, a foundational piece of a modern portfolio. That's why institutions start here. When large financial firms, corporations, and asset managers decide to enter the digital asset space, they almost invariably begin with Bitcoin. They choose it for its security, its liquidity, and its simple, powerful, and predictable monetary policy. It is the bedrock upon which the entire crypto ecosystem is built. Ethereum, the engine of the crypto economy. 30 bogaus, 45 aus. If Bitcoin is money, Ethereum is infrastructure. Ethereum allows programmable money, smart contracts, decentralized applications, tokenized assets, stablecoin issuance. Most people don't realize how much activity happens on Ethereum every single day. Even when you use other blockchains, bridges and liquidity often flow back into Ethereum. Ethereum's strength isn't hype, it's network effect. Developers build where users already exist, liquidity already exists, tools already exist. Ethereum is evolving. It's becoming more efficient, more scalable, more institutional friendly. Smart money views Ethereum as a long-term tech investment, a financial settlement layer, a yield-generating asset through staking. This is why Ethereum is often second only to Bitcoin in serious portfolios. Stablecoins. Why they're quietly dominating. 55 rhymes. Stablecoins are one of the most misunderstood tools in crypto. People think, if it doesn't go up, what's the point? But smart investors understand something important. Liquidity is power. Stablecoins allow you to exit volatility without leaving crypto, move money instantly, buy crashes without panic, stay patient. Institutions love stablecoins because they combine speed, stability, global access. In the future, stablecoins may become the bridge between traditional finance and decentralized finance. Holding stablecoins is not being bearish, it's being strategic. AI, crypto, and emerging themes. 55E 1.5 SIRS. AI crypto is a narrative, not a guarantee. Most projects will fail, that's normal. But some will provide. Decentralized compute, AI data marketplaces, automation tools, infrastructure for future systems. Smart money doesn't chase these blindly. They size positions small. They wait. They observe adoption. This is where asymmetric bets live. High risk, high reward. Portfolio structure and mindset. 11.05 Gauss, 1.15 Gauss. A strong crypto portfolio is built, not guessed. It balances conviction, risk, patience. Rules matter more than predictions. Those who survive multiple cycles are not the smartest. They are the most disciplined. Final message. Why this matters. 115 120 Wow. Crypto is not about timing tops. It's about staying in the game. Education beats hype. Process beats emotion. Consistency beats luck. If you understand this, you're already ahead.